Hello, my name is John Henderson, and I'm here this evening to talk about tax levying authority and practices in metro districts. But first, some introductions. I'm an attorney licensed to practice in Colorado. I've practiced for over 40 years, and during that time in practice, I've represented developers, residents, and I've been a developer myself. But more importantly, I've spent all volunteer time outside of my employment, volunteer time, researching, sharing, educating, and working with residents in metro districts. It began with my metro district when I first moved to Colorado. Even though I was an attorney experienced in land use law, I had never, ever heard of a metro district. So I spent 3 months collecting all of our documents, reading all of those documents, studying them, discussing them, and making sure I understood exactly what was going on. That then led me to share information with others in our community, which then led me to continue to share information with folks outside of our community. I would get calls from real estate agents, from prospective home buyers, parents of prospective home buyers, folks who wanted to understand what metro districts were, and more particularly, what it meant to them as a potential home buyer in a metro district. So I've had the opportunity and really the joy and professional satisfaction of researching metro districts throughout Colorado on behalf of residents, learning their documents, translating their documents for them so they understood what was going on, educating themselves, appeared and presented at numerous town halls, attended numerous meetings, and all with the objective of educating folks about what do these metro districts documents mean, how do they affect their lives, and in particular, how does it affect their pocketbooks. Along the way, I've had the opportunity to present to numerous cities and counties, including Lakewood, Denver, Westminster, Longmont, Timoth, Jefferson County, and others that I've unfortunately forgotten. I've also been honored to be considered as an expert by the Denver Post, the Gazette, and numerous local newspapers. What we're doing this evening is a team effort. No one person can do this, and I've been honored and fortunate to be able to associate with a lot of very smart people who are also experts in this field. And so many thanks to Christina, Fair, Jennifer, Jeff, and of course, Kath and Maud in producing this information, which of course means researching it, writing it, editing it, and then presenting it to you all. So let's begin our journey. Tax levying authority and practices in metro districts. The task force has before it the subject of issues confronting homeowners regarding tax levying authority and practices by metro district boards. And that will be the focus of this presentation. Next slide. The tax levying authority and practice in metro district boards, which affects homeowner rights, can be basically organized into three categories. First, the legislative/constitutional authority, that is, authority given to the boards from the state legislature or the Constitution. Most notably, Title 32, the statute that governs metro districts. Secondly, the service plan, which is approved by a city council or county board of commissioners, the charter for the metro district. And third, a constitutional provision, Tabor elections. Those three things, Title 32, the service plan, and the Tabor provision in the Colorado Constitution, provide tax levying authority to metro district boards from the legislature or the Constitution. The second category of authority is from the developer. The reimbursement and pledge agreements entered into by the developer provide authority by the way of a contract, an agreement, to levy taxes. Similarly, budgets and resolutions passed by developer boards do the same thing, facilitate taxing. The third authority that I'd like to discuss briefly is what I call the common law authority. And that is very simply the common sense notion that there's a debt. Developers want to be paid for the cost of the infrastructure in building the developments. And there's a common law, common sense obligation to pay what is owed. And in the context of addressing these authorities, we'll also refer to the practices, and in particular, toward the end, the practice of paying interest with taxes. The service plan is the first legislative authority that we'll talk about. As I mentioned, it's a charter for metro districts. It outlines the authority provided in the statute, Title 32, and it does a couple things generally. It sets a bond debt for principal. In our community's case, it was $60 million, and that was a limit. The developer could not issue debt in excess of $60 million without getting further permission from the city or the county. Also, the service plans will generally limit the mill rate, the property tax rate that can be charged with a maximum, typically 50 mills, and limit the number of years that the residents will be obligated to pay that debt, typically 30 to 40 years. I've seen as high as 50 years. Next slide, please. The next authority is the constitutional authority, and that's Tabor. In this case, the Tabor election, which is held by developer representatives before the residents arrive, typically within weeks after the district has been, or the service plan has been approved, and in the process of organizing the metro district. Now, Tabor requires voter approval for any tax and bond debt. We know that from other circumstances regarding cities, counties, and states. You have to get the voters' approval in an election to issue bond debt. But in the world of metro districts, that Tabor election can, and almost always does, essentially eliminate the homeowner approval requirement for up to 20 years. And I've referenced Tabor and the Colorado statutes that provide for that. This Tabor election also increases the debt authorization, which is allowed in the service plan, without homeowner approval. You'll recall in the previous slide in Solterra, the service plan set a debt limit, the amount of money that the developer can issue in debt, limited to $60 million. However, in the Tabor election, the developer typically, and in every case I've seen, increases that debt limit typically 10 times. So now the developer can issue debt up to $600 million without ever getting the approval of the voters, of the residents. Next slide, please. Here we have an example of a ballot issue, a Tabor election ballot issue in Solterra's case, and Solterra is Fossil Ridge Metropolitan District. The metro districts are often called something different than the actual community. And you can see the first thing they do is increase the debt limit from 60 million that was set in the service plan, in this case up to 600 million. And we'll see how that works again, because there are 10 of these ballot issues. This one's for mosquito control, which I love. There are others for streets, water, sewer. But the point is that each of these increase the debt limit to 60 million, and there are 10 of them. The other thing it does, it sets a interest rate limit of 18%. And then more importantly, there at the bottom, that language is the language referring to a provision in Tabor that essentially says, if the voters vote to change the limits or sidestep the limits, they can do that. And this is what they did. In essence, they eliminated the right of future residents to vote on any bond debt. And by operation of the statutes, that suspension of those rights is good for 20 years. And they assign the right to issue the bond debt, according to the language here in the ballot issue, to the board of directors. And the board of directors, of course, will be developers until the residents take over the boards. And you'll see at the very bottom, the vote was 8-0. Those 8 people were, and almost always are, the developer, his family, friends, or employees. In the next slide, we see confirmation of what we've just said. This is an excerpt from information that the developer supplies to the bond investors when they go to sell the bonds. It's written by their attorneys. And in the first paragraph, it says, yes, you have to have voter approval before issuing any debt. In this case, voter approval to issue this bond. In the second paragraph, they say we already had that election. In 2006, there was an election, 8-0, voting to approve debt authority, not 60 million, but 600 million. And a toss, including the interest, up to 4.9 billion. And that roughly equals $4.3 million of debt authority per home. Now, just a footnote, this information is provided to the bond investors, roughly 150 to 300 pages of information regarding metro districts. This information is not provided to the residents. And if you go to the website, you won't find this document. Typically, you have to go to an industry website that catalogs bond prospectuses and find it there. The other thing that's missing is when they say there was an election in 2006 authorizing all of this debt, nowhere do they say to the investors that the folks who voted in that 2000 election were not residents. They were the developer, his family, friends, or employees. There are only 8 of them, and they all have a conflict of interest with the residents and future taxpayers. Next slide. We've talked about the 3 government, the 3 legislative or constitutional sources of authority. We talked about the service plan, we talked about Title 32, and we talked about Tabor, the Constitution. Now we're going into that second category of authority, developer reimbursement and pledge agreements. These again are agreements. It's not a statute, it's not a constitution, it's an agreement. These agreements are contracts or agreements, I put in quotes, that the developer enters into with himself. And they obligate the homeowner to pay the developer's cost for the infrastructure. They obligate the homeowner to pay the developer all of the district property tax revenue, and they provide that the developer will set the tax rate. Now, these developer reimbursement and pledge agreements are really important documents. They form the foundation of metro districts and the financial model that metro districts use to tax residents and pay developers. You'll find them in the master servant and CAB districts. You find them essentially in any district that has more than one district per community. Next slide, please. When I say the developer entered into these agreements with themselves, I mean that. Here's the signature line for the for one agreement setting up a cab authority. The same configuration, that is, one person, typically the developer or his employee, signing on behalf of all the districts, is the same in every example I've ever seen of a pledge agreement or a reimbursement agreement, whether it's a master servant district or a CAB district. In every case, one person signs on behalf of all of the districts, including the districts where the residents will live. And here's language from the agreement that I shared with you that says the CAB, which has the developer majority on it, will determine what the actual costs will be, will determine the tax rate that will be set, and in this agreement signed by the developer on behalf of everybody, the resident districts agree to impose the tax rate and pay the costs that the developer district imposes. Next slide, please. Here's what that looks like in a budget. In this particular case, it's a CAB budget out of Sterling Ranch, Colorado. And Sterling Ranch, Colorado Metropolitan District number 3 is the resident district. You see there the revenues, the property taxes that the residents paid to the district and were received by District 3, the resident district. Resident District 3 then turns around and gives it all to the CAB, which is run by the developer district. So here is the decision-making by the resident Metro District Board, which is pursuant to the reimbursement and the pledge agreement to simply pay all of their tax revenue to the developer. Next slide, please. The other developer vehicle for just making taxing and spending decisions, in addition to the agreements we just looked at, are the actual budgets and resolutions. And if you follow the money, the track is pretty clear. The developer advances money, loans money to the district to pay for the infrastructure. The district, resident district, then issues bond debt to pay off the advances. And then once the bonds are issued, the homeowners pay taxes to repay the bond debt, principal and interest. The developer advances money to the district issues bond debt to pay off the advances, the homeowners pay taxes to pay off the debt. Next slide. Here's what that looks like in actual budgets. Going back to Fossil Ridge, Solterra, this is the District number 1 budget. District number 1 was the, I should say, developer district. And at that time, you see in 2016, and this district began in 2006, the developer made advanced money to the developer district. So the developer gave money to the district to pay for infrastructure costs. And there in the next line item, the expenditures, you see that same amount of money plus a little bit more was spent from the advances on capital expenditures. And by the way, that one line item for capital expenditures is all the residents will see in the detail of how those advances are spent. Here we see the next phase of those payments of money. We started with the developer advance, and as I mentioned, those collect after a while. And in this case, in Fossil Ridge, otherwise known as Solterra, after the developer reached a point of collecting developer advances of about $12.5 million, he decided to issue bond debt to essentially cash those out. And so, sitting on the board of the resident district, District 3, the developer and his employees voted to issue bonds in the amount of $12.5 million. Those bonds were sold. A check for $12.5 million came into the District 3 budget, which is the resident district, but at the time it was populated by the developers sitting on the board. And so that district, District 3, took the money that was sent from the bonds, sale of the bonds, deposited it, and then moved that money, the $12.5 million, to District 1, which is the developer district. So the developers on District 3 sent the money to the developers on District 1, and then District 1, which is the developer district, showed the transfer of the $12.5 million from District 3, and then wrote a check to the developer in the same amount. So again, developer advances, they added up, in this case, to $12.5 million. The developer issued a bond to pay himself back. That bond was then sold, and the money that came in was paid to the developer at $12.5 million. Next slide. One of the practices that we see as a result of not only the operation of the statutes and the Tabor election, the Constitution, and the developers' agreements and budget resolutions is the imposition of debt. And again, the Metro District Board has the authority to issue taxes to pay that debt. And last year during the legislative session, we were addressing particular kinds of debt, and it just so happened that I was working with folks in Meadows Metro District 3 and came across their documents which told this story. They had $70 million of principal debt owed to the developer, advances of $70 million to be paid to the developer. The interest had grown on that principal to $253 million in 2017. In 2017, the homeowners are now paying $1.3 million a year from their property taxes to pay down that debt, which of course won't even begin to cover the amount of interest, never mind the principal. And according to the documents, that interest continues to add up so that by 2029, paying interest on the interest, the total debt will be over $500 million. Next slide. And here's what that looks like in the audit 3 years later in 2020. Again, the $70 million principal. Now the interest that was $253 million in 2017 is to $304 million in 2020. And the last line there reminds us that any interest is due and not paid is charged interest. And again, Who entered into these agreements on behalf of the residents? Note 8 above tells us the developer, because he sat on the boards. And as each of the audits must disclose in each of these districts, where the developers are a majority on the board, they have to disclose that the developer, because of his interest in receiving the proceeds of these bonds, has a conflict of interest with the residents who are actually paying those bonds. Next slide. So we come to the common law authority, the debt. If somebody owes you money, it needs to be repaid. And as we've heard throughout the sessions of the task force and during legislative testimony, the developers want to guarantee that they are paid for their costs of the infrastructure. And that, when you boil it all down, is one of the primary reasons for entering into Metro District arrangements. So what is that debt? How much money do the residents owe the developer for the cost of infrastructure? We know from the Special District Association, the SDA, Colorado Homeowners Builders Association, and nationwide, the average cost of infrastructure is $30,000 to $40,000 per lot. And indeed, the SDA and the Home Builders Association have published the statement that without metro districts, homes would cost $30,000 to $40,000 more. That's the cost of the infrastructure. Studies show that the cost of the developed lot paid by the home builder, minus the cost of the land, minus the cost of the infrastructure, still provides a significant profit. Studies show that $30,000 to $40,000 per lot is covered by the cost of the developed lot. Next slide. In Solterra, several residents got together, did a study, and did the arithmetic. They calculated how much money had been paid to the developer for the cost of the developed lot, and of course was paid when the homeowners bought their homes. They subtracted out the amount of money that it cost to put the infrastructure in. They subtracted out the amount of money the developer paid for the cost of the land. And what was left over, in this case, $75.9 million, was profit to the developer from the sales of the developed lot. And this was before Metro District financing. Similar studies have been done in other districts. Next slide. In this district, the result showed that the developer made a 40% return on his costs even before Metro districts. With the Metro District debt, 96% return. And on the next slide, we see another example where the return on investment was 79% before Metro districts. And keep in mind, the average return on investment for a developer is 15 to 35%. So the bottom line, next slide. How does the taxing authority and practices of Metro District boards impact homeowners? Bottom line is here. More in taxes. Comparison was made with a similar house just down the street from each other. One house, about the same amount of money, same cost, $700,000, in a area that did not have a Metro District, compared with a similar cost house in a Metro District. And you can see that the Metro District taxes were $4,500, and the tax burden in a similar home in a non-metro district was 0 because there was no metro district. So similar houses, a couple blocks away from each other, one homeowner is paying $4,500 more each year in taxes because they're in a metro district. And it's not spelled out, but note here the amount of taxes, the tax rate. In the metro district, the homeowner there is paying 55% of his total taxes to pay back developer debt. 96.2 mils to pay back metro district debt. 55% more than all of the taxes paid for school districts, water, pest control, city and county. Next slide. The homeowner's rights after tax levying practices of boards essentially establishes a conflict between the residents' rights to vote and self-government and the developers' interest in running metro districts to guarantee they get paid back what they believe they're owed. And this conflict, unfortunately, is irreconcilable. And the conflict is real, as has been addressed before. There's litigation. Residents are awakening to the right they have to preside over their own taxing and spending decisions, and developers are suing residents for trying to exercise those rights. As one of the panelists mentioned in the last session, developers don't trust the residents, so they're working to keep the residents out of the decision-making positions as long as they can. And on the other hand, residents don't trust the developers because they're trying to obstruct the residents' ability to participate in self-government. Thank you for your time. I hope this information, again, will help advance the learning curve on the actual operation of the tax authority and the practices for issuing taxes in metro districts. Thank you again.